Welcome back to the Deep Dive.
Great to be here.
So today we're doing what we always do. We've got this huge stack of sources articles, a bunch of internal research, market analysis.
All kinds of material.
We're going to try and boil it all down for you. Our topic today is the casual dining sector. We're asking a pretty simple question. Why was 2025 such a financial disaster for restaurant stocks?
And maybe more importantly,
And what is cooking up what looks like a massive rebound for chains like, say, Darden and Texas Roadhouse in 2026?
it was a brutal year, to put it mildly. And when you synthesize all this material, you see the story is much more complex than just, inflation was high.
Right. It's never that simple.
It's this fascinating mix of volatile commodity markets, a really deep psychological shift in how consumers think about value, and even some surprising policy tailwinds that are all sort of converging at once.
Okay, let's unpack this. We've got analysis on why major players like Darden, that's the Olive Garden owner, and Texas Roadhouse they were basically fighting to just tread water. So our mission today is crystal clear. We need to pull apart the data, find the pain points from 2025, and then reveal these surprising, almost counterintuitive catalysts that could bring this sizzle back.
And that context from last year is so important. The whole restaurant sector struggled, which tells you consumers were retreating across the board.
It wasn't just one company having a bad quarter.
Not at all. Even Darden, which everyone considered a relative star of the group, it barely managed a 1.6% gain for the year.
1.6%. I mean, you would have done much better in a basic S&P 500 index fund, or even just a high-yield money market account.
Oh, easily.
That really puts the struggle in perspective. When your best performer is basically flat, you know the whole sector's in trouble.
Exactly.
And the company we're going to focus on a lot today, Texas Roadhouse, ticker TXRH, actually shed a painful 6.6% of its value last year.
Yeah, that one hurt.
So let's jump right into the why. What was the absolute primary pressure point in 2025?
It was pretty straightforward economics, really. It just hit household budgets hard. A lot of U.S. consumers, they were facing this persistent inflation everywhere.
Gas, housing, everything.
Everything. And they decided that dining out was the most logical place to cut their discretionary spending. It was the easy thing to chop to shore up their finances.
And the data around that decision is what I found so compelling in these sources. We talk about inflation as this one big number, but there was this huge disparity between restaurant inflation and grocery inflation.
Yes, and that disparity is key. It's fascinating how severe it became. The November Consumer Price Index report showed that the year-over-year increase for eating at home, so your groceries.
What you put in your cart.
Right. That was only about 1.9%, which is, relatively under control.
And the comparison. How did dining out look?
The food away from home category was nearly double that.
Double, wow.
It just became objectively financially cheaper to cook at home. A family could feed themselves for way less. Dining out went from being an affordable little treat to, for many, an outright luxury they just weren't willing to pay for.
And that consumer tolerance wasn't just about the price tag, was it? The sources talk a lot about this sense of being, cheated, this idea of shrinkflation.
That's absolutely right. Shrinkflation, getting smaller portions for the same or even a higher price was rampant.
Especially in fast casual.
Exactly. So you combine the higher prices with this feeling that you're getting less food. You completely shatter the value proposition.
Yeah.
Consumers felt they were paying a luxury price for a worse product. And that psychological feeling of, I'm paying more for less, that eroded confidence across the entire dining world.
That erosion brings us right to a company whose whole business model made it uniquely vulnerable here. Texas Roadhouse.
Well, yeah. If your entire brand is built around big, high-quality steaks and burgers, you are making a massive bet on the price of beef.
You're all in on beef.
You're all in. Texas Roadhouse is hypersensitive to swings in commodity prices, especially beef. It's their single biggest input cost.
And 2025 delivered a catastrophic swing. Beef prices just surged. And that hit all the burger and steak-focused chains. So management has this terrible choice.
It's a horrible choice. You either eat the costs, which just crushes your margins, or you try to pass them on to your customers.
Which feeds right back into that consumer resistance we were just talking about.
That's the vicious cycle that got them into trouble. And you can see the pain right in their key data points. Like we said, the stock lost 6.6%.
Okay.
And while their market cap is a solid $12 billion, The pressure on the bottom line is clear. Look at their gross margin, 13.27%.
Wait, hold on. 13.7% gross margin. I mean, for a restaurant, is that actually low? You're making 13 cents on every dollar of sales before other costs?
It is low. It's really low when you think about their high fixed costs, rent, utilities, all that equipment. Steakhouse chains already operate on thinner margins than, say, a software company. But when commodity inflation runs as hot as it did in 2025, that thin margin just removes all your options.
It ties your hands.
Completely. It limits what you can spend on marketing, on new stores, or, and this is the crucial part, on keeping menu prices stable to attract that value-conscious customer. They were walking a very, very tightrope.
So we've painted the grim picture of 2025. Soaring beef prices, restaurant inflation, double the grocery rate, shrinkflation making people feel ripped off.
A perfect storm.
But here's the turn. Because the sources suggest the very thing that punished the sector, those rising fast casual prices, might be the exact mechanism for the rebound in 2026.
This is where we get into the psychology of perceived value, which is maybe the most important concept in this whole deep dive.
Okay.
Value isn't just about the number on the receipt. It's about what you feel you're getting for your money. And as prices at fast food and fast casual places, the places people used to see as the cheap, quick options started to climb, a tipping point was reached.
And I think we've all felt this. You grab a burger, fries, and a shake at a drive-thru, and suddenly the bill is $18, maybe $20.
Exactly. That same meal used to be $12. There was a huge price gap between that and a sit-down meal. But now that the gap has shrunk, consumers are doing this new math in their heads.
And a new calculation.
Yeah, a psychological one. They're thinking, okay, if I'm going to spend a lot more either way, say $22 or $25, I'd rather spend it at a sit-down restaurant.
With a waiter, maybe a breadbasket.
A whole atmosphere, exactly.
The fast casual chains basically price themselves into direct competition with casual dining, which they never wanted to do.
Never. And this value migration people moving their spending from overpriced fast food back to sit-down places, that's the key driver for Darden and Texas Roadhouse in 2026.
They're chasing the better perceived value.
That's the core insight. For just a few extra dollars, they get a full-service experience. This trend of trading up from fast casual to full-service casual dining is this powerful systemic lift that could really boost their results.
And we're seeing Darden is moving aggressively to capture this returning customer. They're aiming for pretty robust revenue growth in 2026, somewhere between 8.5% and 9.3%. And their flagship, Olive Garden, is leaning into strategies that reinforce that sense of value.
Their strategy is really smart. They see the shift. Olive Garden is focusing on introducing healthier, lighter portions.
Which isn't just about calories, right?
No, it's not just about Weight Watching. It's about giving you menu options that fight that feeling of a heavy, expensive meal that sometimes you associate with casual dining and helps you rationalize the cost because you feel like you're getting a more thoughtful, maybe higher quality experience.
So it's a complete package. The value calculation shifts in their favor, and then the chains tweak their menus to maximize that appeal. But beyond consumer psychology and menu items, our sources point to a totally different, surprising macro category that could be the final fuel for this rebound policy.
This is truly fascinating because the effects are indirect, but they could be massive.
And we should be really clear here, as we always try to be.
Yes.
We are just impartially reporting on the content in our sources. They happen to mention President Donald Trump's big, beautiful bill, I think is the quote.
That's the one.
Our focus here is purely on the economic mechanism of the legislation as it impacts the dining industry's performance, not the politics.
Exactly. So let's focus on the legislation's no tax policies on overtime and tips, which go into effect this year. The sources suggest this creates a really powerful dual catalyst, starting with employee retention.
Right. And the dining industry has a notoriously terrible problem with high staff turnover.
Oh, it's endemic. And let's just break down the economics of that for a second. High turnover is financially crippling for a restaurant.
You have to hire, train.
You spend so much money just to recruit, train, and onboard a new server or a cook. I mean, estimates suggest replacing a single hourly employee can cost thousands of dollars when you factor in all the lost time and inefficiency.
So how do these new tax policies help with retention?
What's crucial to understand is that the benefit isn't a direct profit boost for the employer. The benefit is entirely on the employee's side.
Okay.
By reducing the tax burden on tips and overtime pay, the staff gets to keep significantly more of their income. For a service worker, that immediate financial relief Just seeing more cash in your pocket every week makes that job way more attractive.
It makes it more tolerable compared to other similar service jobs.
Precisely. And that improved staff stability, less churn, more experienced employees, that feeds directly back into the customer experience, which reinforces the higher perceived value we just talked about.
It's a positive feedback loop.
It is. Experienced staff provide better, faster service. Better service leads to happier customers. Happier customers means repeat business. So this operational boost, which stems indirectly from a tax policy change, reduces those hidden costs and makes the whole value proposition stronger.
That's the operational side.
Sure.
Staff stability. But the policies also connect back to the consumer spending side. That's the second half of this dual catalyst, right?
This is the other critical piece. Who else benefits from these tax changes? It's not just restaurant workers.
Right.
You have workers in other fields keeping more of their overtime pay, and you have the prospect of larger general tax rebate checks for everyone.
Yeah.
All of that translates into a systemic boost for consumer discretionary income across the whole economy.
So two streams of cash flowing back to consumers, retained earnings from workers in other industries, and bigger tax rebates for the general population.
That's it. So you've got this combination of more cash in consumers' pockets,
All right.
funneling into a category, casual dining, that is simultaneously benefiting from that value migration trend we discussed and improved quality due to staff stability. That's a potent triple catalyst.
It just transforms the whole environment for these companies.
It shifts the entire narrative from dining out is too expensive and the service is slipping to, dining out actually feels like a good value again, and the experience is reliable.
So for you, the listener, the core insight here is that stock performance in this sector is dictated by this really fragile, interconnected balance. It's commodity costs, it's inflation rates, but most crucially, it's that psychological calculation of perceived value for every single dollar a consumer spends.
And the 2026 recipe for success seems to be all about minimizing those commodity headwinds while maximizing that perceived value. It's a phenomenal example of how financial analysis requires you to synthesize everything from beef futures to legislative details, all through the lens of human psychology.
And as we wrap up, that policy factor is something really worth spending more time thinking about.
I agree.
If changes in how we tax overtime and tips become such a significant, measurable lever for stock performance, by improving retention and boosting consumer cash, how much weight does future legislative stability need to carry in your investment strategy, not just for restaurants, but for all consumer-facing industries?
That's a great question.
What other indirect policy effects, maybe around minimum wage in certain states, should you be watching for in the next quarterly report? That's your assignment for deeper exploration. Thanks for diving in with us.
Always a pleasure.